Hello, viewers. Last Tuesday morning, I stepped into a mortgage broker's office in Parramatta, and the silence in the room felt heavy. Melissa Gilnick was seated at her desk, scanning through client files. When she looked up and spoke, what she said stopped me cold. According to her, 1 out of every 4 people who contact her today are completely stuck. They can't refinance, they can't sell, and they have no realistic way out. These homeowners are paying interest rates they simply can't afford anymore on properties now worth less than the debt attached to them. Meanwhile, better mortgage deals exist just beyond their reach, separated by rules and calculations they can't pass. Melissa has a name for these people. She calls them mortgage prisoners. And right now, there are around 800,000 mortgage prisoners across Australia. This situation goes far beyond ordinary mortgage stress. This isn't about families tightening their budgets, but still keeping their heads above water. This is a structural problem, a financial trap created by policy, lending rules, and a rapid shift in interest rates that lock the exits behind homeowners who thought they were doing everything right. To understand how this happened and why the situation is getting worse, we need to break down what mortgage prison really means. A mortgage prisoner is a homeowner who cannot refinance their loan, even though switching lenders would save them thousands of dollars every year. They are forced to stay with their current bank, paying whatever rate that lender sets, because no other institution will approve them for a new loan. The reasons vary, but the outcome is always the same: financial pressure with no escape route. The biggest contributor to mortgage prison in Australia is the serviceability buffer. When someone applies to refinance, banks don't assess whether the borrower can afford repayments at the current interest rate. Instead, they must test affordability at a rate 3 percentage points higher. This rule is set by the Australian Prudential Regulation Authority and applies across the banking system. So if a borrower wants to refinance to a loan at 6%, the bank must check whether they could still manage repayments at 9%. The buffer is designed to protect borrowers from future rate rises, but in practice, it has become a wall that many people simply cannot climb. Homeowners who took out loans when interest rates were around 2% are now paying closer to 6%. They are already meeting these higher repayments every month. Yet when they try to refinance, they fail the serviceability test, not because they can't afford their current loan, but because their income can't support a hypothetical interest rate that may never actually occur. As a result, they remain trapped, paying higher rates, while cheaper options remain inaccessible. The second major barrier is loan-to-value ratio, or LVR. If a property has fallen in value since purchase, the LVR increases. Most lenders will not refinance loans above 80% LVR unless the borrower pays lender's mortgage insurance. That insurance can cost tens of thousands of dollars. For households already under financial strain, finding an extra $30,000 or $40,000 just to refinance is simply not possible. So once again, they stay locked in. The third and most severe trap is negative equity. When the loan balance exceeds the value of the property, refinancing becomes impossible. Selling isn't an option either unless the homeowner can bring cash to settlement to cover the shortfall. For many families, that money simply doesn't exist. Data from Compare Club shows how widespread this problem has become. The share of refinancing applicants with loan-to-value ratios above 91% jumped from 14% in April 2022 to 20% by late 2023. A 42% increase in highly leveraged borrowers trying and failing to escape their loans. New South Wales has the highest concentration, with 19% of mortgage holders sitting at LVRs of 91% or higher. Victoria is close behind. These aren't reckless borrowers. Many purchased homes in 2021 and early 2022 with 10% deposits because that was the only way into the market. Property prices were at record highs, interest rates were low, and banks approved the loans. Then prices fell, rates surged, and the equity they believed they were building disappeared almost overnight. At the same time, around 800,000 Australians are rolling off ultra-low fixed-rate mortgages during 2024 and 2025. These loans were written in 2020 and 2021 when the Reserve Bank cash rate sat at 0.1% and fixed rates were commonly between 1.99% and 2.5%. When those fixed periods end, repayments don't rise gradually. They jump, often doubling. A $600,000 mortgage at 2.2% costs roughly $2,300 per month. At 6.4%, the same loan requires repayments of about $4,600. That's an extra $2,300 every single month. For households already dealing with higher food prices, fuel costs, insurance premiums, and utility bills, there's nowhere left to cut. Refinancing becomes essential, but the serviceability buffer blocks the door. Even after recent rate cuts, the problem remains. A borrower refinancing from 6.4% to 5.4% still has to pass an assessment rate above 8%. The numbers simply don't work. Victoria recorded the highest number of calls to the National Debt Helpline in 2024, with more than 3,500 people seeking financial counselling, the highest level in 7 years. The main reason was difficulty keeping up with home loan repayments. Mortgage brokers across the state report that buyers who entered the market between 2018 and 2021 are under the most pressure. Melissa Gilnick, Director of Smart Lending, told media in early 2025 that 1 in 4 of her clients are now mortgage prisoners. They can't refinance. They can't consolidate debt. They're stuck. Some homeowners are trying to survive by increasing their income. Clients are taking second jobs, freelancing, working weekends, or joining the gig economy, sometimes earning an extra $30,000 a year just to stay afloat. Others are making deeper sacrifices. Parents are returning from maternity leave earlier than planned. Spare bedrooms are being rented out on Airbnb. Families rely on grandparents for childcare while working longer hours. These aren't short-term fixes. They're permanent lifestyle changes forced by a system with no exit. New South Wales holds the largest number of mortgage prisoners in raw terms. Nearly 1 in 5 homeowners in the state has an LVR above 91%. For a $700,000 loan at 92% LVR, lenders' mortgage insurance alone can exceed $25,000, money most struggling households don't have. Court data shows that in the first half of 2023, New South Wales issued 346 rates for home repossession. That's about 13 homes per week entering foreclosure, and the pace is increasing. Western Sydney suburbs are among the hardest hit. Campbelltown, Liverpool, Blacktown, Mount Druitt and Penrith all show elevated arrears and rising distress. These areas are far from the CBD, with long commutes and households that borrowed close to their maximum capacity to enter the market. When fixed rates ended and repayments doubled, there was no margin left. Some lenders introduced limited refinancing exemptions in late 2023, reducing the serviceability buffer to 1% for certain borrowers. But the criteria were strict: strong repayment history, LVR, below 80%, no additional borrowing, and principal and interest repayments. Most mortgage prisoners fail at least one of these conditions. Consider a couple in Melbourne's southeast who bought in Officer in 2021 for $680,000 with a 10% deposit. Their loan of $612,000 was fixed at 2.4%, costing $2,400 per month. When the loan reverted to 6.35%, repayments jumped to $4,700. Their combined after-tax income is $8,200 per month. After the mortgage, just $3,500 remains for all other expenses. Refinancing to a cheaper rate was rejected after a valuation came back at $620,000, leaving them with a 98.4% LVR. They can't refinance. They can't sell. They're bleeding cash every month. That is mortgage prison. When hundreds of thousands of households are trapped like this, the effects ripple through the economy. Consumer spending drops. Defaults rise. Banks tighten lending further. Families lose mobility and become anchored to properties they can't afford and can't leave. Despite this, there has been no major policy response. The expectation appears to be that rate cuts will fix the issue. But without changes to the serviceability buffer, refinancing barriers remain. Until equity improves, incomes rise significantly, or regulatory settings change, mortgage prisoners stay locked in place. For many Australians, home ownership has stopped being a source of security. Instead, it has become a financial weight they cannot escape. This is the mortgage prison crisis facing Australia today, and it's happening quietly, behind closed doors, while hundreds of thousands of families wait for a way out that may never come. Aussie Property Hub will continue to track and explain these issues so homeowners understand what's happening and why it matters. Stay alert, be safe, take care. Everyone subscribe my channel. I'll see you soon.